You're chasing bigger trading goals, but the secret isn't more trades, it's how much you trade. Today I'm handing you the exact position sizing blueprint market wizards use to turn small accounts into big accounts without blowing your account in the process. If you're new here, I'm Sam, a brokerage insider, and your shortcut to what's really important in trading. Stick around because by the end of this video, you'll walk away with a plug and play formula to calculate exactly how many lots to trade, and 3 position sizing models you can use to limit losses and grow your trading account without having to be an expert at picking the market. So let's get started. Part 1, why position sizing beats entry price. Steve Clark, the market wizard, said entry size is more important than entry price. William Eckhart doubled down and said, money management beats the price model. That's not to say your entry and exit rules don't matter. They absolutely do. But position sizing arguably plays an even bigger role because it directly determines your risk and ties into your overall money management strategies. Let's break this down with a simple scenario. You have a $10,000 trading account. You find a setup you like and you decide to risk 50 pips with a target of 150 pips. Same account size, same stop loss, same profit target. But depending on your position sizing model, the outcome can look very different. Model 1, this is the fixed lot size. You choose to trade one standard lot, that's 100,000 units, and each pip is worth $10. You win 150 pips times 10, that's $1,500 profit. Or if you lose, it's 50 pips times $10, it's a $500 loss. Model 2 is using full leverage. You use your full 100 to 1 leverage to open a 10 lot position. That's 1 million in trade size. Each pip is worth $100. A winning trade is 150 pips times $100, that's $15,000 in profit. A losing trade is 50 pips times $100, that's $5,000 loss. In Model 3, it's a fixed percentage risk, so you risk 2% of your equity, and that's $200. With a 50 pip stop, each pip must be worth $4, so your trade size is $40,000. A win is 150 times $4, that's $600 profit. A loss is 50 times $4, that's a $200 loss. Same stop, same target, but depending on how you size your position, the dollar outcome varies drastically. The takeaway is that your position sizing model acts as a layer on top of your entry and exit rules, and it has the power to shape your results more than you might expect. So now you know this, you must first decide on your trading objectives. So part 2, the objective-based calculator. So before you decide on your position size, and ideally before you make any trades, you should decide on your trading goals first. So first you want to decide on your annual return, your maximum drawdown, which is like your stomachache limit, your expected trades, the number of trades you want to take a month, and the risk-reward ratio you're targeting. Then you'll decide how much capital you'll dedicate to the strategy. And from there you can calculate what your position size should be. But first you need to calculate your risk per trade in dollars. So click on the link in the description for MarketMate's position size calculator. It's preset to risk 1% per trade, but you can adjust this. As explained in my Forex strategy video, I like to go for a higher risk-reward ratio because one solid winner can wipe out a string of small losses. So you enter your capital, number of trades, your win rate, your risk-reward ratio, and then tweak the risk per trade field until the calculator's projected return aligns with the target return in your system objectives. The dollar amount that now shows as 1R is your risk per trade in dollars. But before locking it in, verify the drawdown. The calculation uses a Monte Carlo simulator, so results vary slightly each run. If the projected maximum drawdown exceeds your comfort level, lower the risk per trade percentage until it falls within your limit. As real world results come in, you'll refine the number to fit your system's actual performance. And after calculating your risk per trade in dollars, we can then calculate your position size. Part 3, the position sizing formula. This is the formula we use for this. Trade size in pips equals risk per trade in dollars divided by the stop distance in pips. So step 1, decide your risk per trade. This is also the amount that you should have calculated in the previous step based on your trading goals. In step 2, you set your desired stop loss. Let's say for this example, you want to put your stop loss 50 pips away. In step 3, you calculate dollars per pip. So you divide your risk by the stop distance. The trade size in pips equals the risk per trade in dollars divided by the stop distance in pips. So it's $100 divided by 50 pips, which equals $2 per pip. In step 4, convert dollars per pip to lot size. In most major USD pairs, one standard lot, that's 100,000 units, moves $10 per pip. So $2 divided by 10 equals 0.2 standard lots. That equals 2 mini lots, or 20 micro lots. So in this example, you should have 0.2 standard lots. If price hits your $50 pip stop, you lose the planned $100, exactly 1% of your account. But luckily, most trading platforms like ours at MarketMates have built-in position size calculators. So you can plug in your risk and stop loss and let the software do the math in real time. Part 4, position sizing models. These are models that you can start using today. Model 1 is guard your core capital, because there's two types of money you'll be risking when trading: your core capital and markets money. Markets money is the money you've earned from trading on top of your core capital. So before you start making markets money and are confident in your system, trade small, like half size or quarter size. Then when you've become more profitable, you start risking larger sizes. For example, I calculate my risk per trade at 0.5%, but on starting a brand new system, I lowered it to 0.2%. Once the system proved itself, I dialed it back up to the full 0.5%. So protect first and scale later. Model 2, fire bullets, not cannonballs. This one's for day traders. Instead of thinking risk per trade, think risk per day. If you've got a 100K account, set a hard daily loss limit, for example, $1,000. If you reach that limit, stop trading. So now what you do is you split that 1K into risk bullets. If you're planning 5 trades, that's $200 risk each. If you're feeling confident, push to $300 per shot. But here's the non-negotiable. Hit your limit and you're out. Your capital is protected and you can start regrouping and analyzing what went wrong so you can improve for tomorrow. Remember, discipline trumps dopamine. Model 3, bet bigger on higher conviction plays. Not all setups are created equal. Conviction-based position sizing means trading a larger size on high conviction trades. If your baseline is 1% of your account, you could crank it up to 2% or 3% if you see a high conviction setup, or level up with a scale and strategy. So you enter small. If the price moves your way, you add to your position. You might add 3 to 5 times or even more, but each time you add, you move the stop loss on the entire position tighter, so your total risk never exceeds that 2 or 3%. But you don't start here, you graduate here. Remember this model when you become an advanced trader. Scaling in on a conviction based model is my favorite way to trade, and I do it all the time. This helps me to end up with a large position that can generate significant returns if the market goes my way. But if it goes against me, I only have a small loss or a break-even trade. And all this without ever having to tighten my stop too close to the market. While it can be tough to do psychologically for many traders as they want to take profits quickly, it's an extremely good way for the disciplined trader to trade. So entries and exits tell you if a trade makes sense, but position sizing decides whether that sense translates into dollars or disasters. Your position sizing model needs to line up with your system objectives. And this is one of the main areas where I see traders go wrong. Click on the link below to try MarketMates position sizing calculator and watch the video below to learn about 10 secrets I learned while working for Forex brokers. Hope this was helpful, and I'll see you in the next one.